The signal the market can no longer ignore. We are approaching a critical moment in the global silver market, a moment where numbers are beginning to reveal a reality that most investors are not prepared to face. As of Sunday, December 28th, 2025, markets are closed, but the imbalances are not. Over the past several days, an abnormal and historically rare divergence has appeared between silver prices in Asia and the United States, and this divergence is not a technical anomaly. It is a physical warning signal. Silver prices on the Shanghai Futures Exchange have been trading at a massive premium compared to prices on the COMEX in New York. Historically, price differences between these two markets fluctuate between 25 cents and $1 per ounce, reflecting transportation costs, taxes, and timing differences. That is normal. What is not normal is a premium that widened from $3 to $5 and then to nearly $8 per ounce just before Christmas. An $8 gap between two major global pricing hubs is not noise. It is stress. In a normally supplied market, such an arbitrage opportunity would vanish almost instantly. Large trading houses would buy silver in New York, ship it to Asia, and close the gap. The fact that this is not happening tells us something very specific. Physical silver is not readily available in sufficient quantity to execute that arbitrage. In simple terms, the metal is not where the paper says it should be. This divergence comes after months of accelerating price action. In August, silver reached $40, in September, $45. October saw $50, November $55. December did not stop at $60. It moved through $65, $70, and even $75 per ounce. This is not a slow grind higher. This is acceleration, and acceleration in commodities almost always signals a supply-side constraint rather than speculative enthusiasm alone. To understand why this matters, we need to look at the structure of the futures market itself. On the COMEX, open interest in silver currently stands at roughly 150,000 contracts. Each contract represents 5,000 ounces of silver. That means more than 750 million ounces of silver have been sold and purchased on paper for future delivery. Against that number, the amount of registered silver actually available for delivery is approximately 113 million ounces. This imbalance is not new, but its scale is growing. In normal conditions, it is not a problem because most futures contracts are rolled forward or settled in cash. Very few participants demand physical delivery. The system relies on that behavior. The problem arises when delivery requests increase at the same time that physical inventories are declining. And that is exactly what has been happening over the past year. Silver production has been declining for nearly a decade. Unlike gold, silver is primarily produced as a byproduct of other metals such as copper, zinc, and lead. Even if the silver price rises sharply, production does not automatically increase unless those other metals are also being mined more aggressively. As a result, higher prices do not immediately solve supply shortages. For 2025, global silver mine production is estimated at approximately 985 million ounces. Demand, however, is estimated at over 1.1 billion ounces. That leaves a structural deficit of more than 100 million ounces. This deficit has been filled by above-ground stocks, inventories held by exchanges, ETFs, and institutions. But those stocks are shrinking year after year. As inventories decline, the paper market can continue to function only as long as confidence remains intact. Once confidence weakens, paper promises begin to be questioned. The widening gap between Shanghai and New York prices is not just about geography. It is about trust and deliverability. This is why price alone does not tell the full story. When futures prices diverge from physical availability, the market enters a different phase. At that point, volatility increases and price discovery becomes disorderly. Thin holiday trading conditions amplify these effects. Between Christmas and New Year, markets operate with reduced staff, limited risk-taking authority, and minimal liquidity. Large orders move prices more aggressively because fewer participants are authorized to absorb them. That is why sharp price movements during this period must be interpreted carefully. They can exaggerate underlying trends, but they do not create trends that do not exist. They simply expose them. The stress we are seeing did not appear because of holiday trading. It appeared because physical supply constraints were already present. As markets reopen fully in early January, participants will have to confront these imbalances directly. The question is not whether silver prices are volatile. The question is whether the market can continue to reconcile paper promises with physical reality without forcing a repricing. In the next part, we will examine who actually consumes silver, why certain industries cannot substitute it, and why availability matters far more than price for industrial buyers. Because once industry realizes that supply security is at risk, behavior changes rapidly and markets follow. To understand why the current tension in the silver market is fundamentally different from previous price rallies, we must shift focus away from investors and toward industrial consumers. Silver is not just a monetary metal or a speculative asset. It is a critical industrial input, and for certain sectors, it is irreplaceable. When supply tightens, these industries do not negotiate with price. They secure availability at almost any cost. The largest industrial consumer of silver today is the solar energy sector. Photovoltaic panel manufacturing consumes close to 30% of all newly produced silver globally. This demand has grown steadily over the past decade and continues to accelerate as governments push energy transition policies. Silver is essential in solar panels due to its unmatched electrical conductivity and reliability. There is no substitute that delivers the same performance at scale. If silver supply is interrupted, solar panel production does not slow down, it stops. For solar manufacturers, the silver price is a minor component of total production cost. A move from $30 to $100 per ounce barely affects the final price of a solar panel. What matters is continuity of supply. A production halt caused by material shortage would be catastrophic, far outweighing any cost increase from higher silver prices. This asymmetry fundamentally changes buying behavior when supply risk emerges. The second major consumer group is the technology sector. Electronics manufacturers rely on silver for circuit boards, connectors, microprocessors, and advanced computing systems. Companies involved in semiconductors, data centers, consumer electronics, and artificial intelligence infrastructure collectively consume between 12 and 15% of annual silver production. In these industries, silver is used in small quantities per unit, but without it, manufacturing becomes impossible. As with solar, silver cost is not the constraint. Availability is. When supply chains function smoothly, companies operate on just-in-time inventory models, holding only weeks of raw material. This model assumes that suppliers can always deliver on schedule. The moment that assumption becomes questionable, risk management behavior changes immediately. The automotive sector adds another layer of demand. Modern vehicles, especially electric vehicles, require silver for electrical systems, sensors, and battery management. Each vehicle contains between 0.8 and 1.6 ounces of silver. For manufacturers producing millions of vehicles per year, this translates into millions of ounces of required supply annually. Again, silver cost has negligible impact on vehicle pricing. But supply interruptions shut down entire production lines. This is where the current situation becomes dangerous. When multiple industries simultaneously realize that silver availability is uncertain, they do not wait for confirmation. They act preemptively. They increase inventories, renegotiate long-term supply contracts, and attempt to lock in future deliveries. This behavior alone tightens the market further, creating a feedback loop that accelerates shortages. This dynamic explains why futures market pricing can become disconnected from physical reality. Futures contracts assume liquidity and optionality. Industrial consumers assume continuity and certainty. When those assumptions collide, physical metal takes precedence over paper claims. This is also why margin increases on futures exchanges matter less than many assume. When exchanges raise margin requirements, they force leveraged traders to reduce positions. Under normal circumstances, this cools speculative excess and stabilizes prices. But when industrial demand is driven by supply security rather than price appreciation, forced selling on paper markets may not reduce real-world demand. It may simply transfer metal from weak hands to stronger hands. Another factor intensifying the situation is export policy. Beginning January 1st, China is implementing new export controls on strategic metals, including silver. These controls introduce administrative barriers, approval requirements, and delays that significantly restrict outbound supply. While not officially labeled as a ban, the effect is the same. Less silver leaves China, and more remains available for domestic industries. In recent years, China has exported tens of millions of ounces of silver annually to Western markets. Under the new framework, that flow is expected to decline sharply. This removes an important pressure valve from the global system. Western markets that previously relied on Asian exports to balance deficits may find that supply no longer arrives when needed. At the same time, above-ground inventories held by exchange-traded funds represent one of the last major sources of accessible silver. These holdings amount to roughly 1 billion ounces globally, approximately equal to 1 year of global demand. However, these inventories are not guaranteed supply. They are owned by investors, not producers. Investors sell only when price incentives are sufficient or when forced by external conditions. If industrial buyers are forced to compete with investors for this metal, price discovery becomes nonlinear. Prices do not rise gradually. They gap higher as sellers withdraw and buyers chase availability. This is where systemic risk enters the picture. Futures markets are designed for price hedging, not supply guarantees. In extreme cases, exchanges retain the authority to settle contracts in cash rather than physical metal. For industrial users, when often relying on futures for supply security, cash settlement solves nothing. It provides money, not material. When production lines are at risk, cash becomes secondary. If even a small percentage of futures holders demand delivery simultaneously, available registered inventories could be exhausted quickly. At that point, confidence erodes. and participants reassess counterparty risk across the system. This does not require panic. It requires awareness. Awareness spreads faster than supply can adjust. In the next part, we will examine how futures exchanges respond under stress, why margin mechanics can amplify volatility, and how rapid repricing can occur even without speculative mania. Because in commodity markets, when time runs out, price follows. When commodity markets move into a phase of physical constraint, futures exchanges are forced into a defensive posture. Their primary objective is no longer efficient price discovery. It becomes stability, containment, and risk management. This shift in priorities explains many of the mechanisms that appear during periods of extreme volatility, particularly margin increases and circuit breakers. Futures markets are highly leveraged systems. In silver, one contract controls 5,000 ounces of metal. At $75 per ounce, that represents $375,000 of notional exposure. Margin requirements determine how much capital a trader must post to hold that position. Prior to recent moves, margin on silver futures stood near $22,000 per contract. That allows leverage of roughly 17 times. In volatile conditions, exchanges typically raise margin to reduce leverage and force weaker participants to exit. Margin hikes are often misunderstood. They are not neutral actions. They selectively target participants with limited liquidity. Large institutions can usually meet higher margin requirements without difficulty. Smaller traders, hedge funds, and highly leveraged players cannot. When margin rises, those participants are forced to reduce or liquidate positions immediately, regardless of market outlook. This creates selling pressure that would not otherwise exist. Under normal conditions, this forced selling helps cool overheated markets. Under conditions of physical scarcity, it may have the opposite effect. Paper selling does not create metal. It only transfers claims. If industrial demand remains constant or increases due to supply anxiety, forced selling on futures markets may simply provide entry points for buyers with stronger balance sheets and longer time horizons. Another misunderstood mechanism is the price dynamic circuit breaker. Contrary to popular belief, futures markets no longer operate under strict daily limit up or limit down rules. Instead, dynamic circuit breakers pause trading briefly when price moves exceed a defined percentage within a short time window. In silver, this threshold is approximately 10%. When triggered, trading halts for a few minutes, allowing participants to reassess positions before trading resumes. These pauses do not reverse trends. They merely interrupt momentum temporarily. In fast-moving markets, multiple circuit breakers can trigger in succession. The effect is not stabilization, but fragmentation. Liquidity becomes intermittent, bid-ask spreads widen, and price discovery becomes jumpy. This environment favors participants who already hold physical metal or long-term exposure and disadvantages those attempting short-term tactical trades. The stress becomes more severe when short positions dominate the market. Historically, certain large financial institutions have maintained significant short exposure in silver futures. These positions may be part of hedging programs, structured products, or market-making activities. Regardless of intent, large short exposure becomes dangerous when prices rise rapidly and margin requirements increase simultaneously. Short sellers must post additional margin as prices rise. If prices rise faster than capital can be deployed, positions must be closed. This creates a short covering feedback loop. Covering shorts means buying futures, which pushes prices higher, triggering additional margin calls. This dynamic does not require panic. It requires mathematics. The key risk here is timing. If price moves are gradual, institutions can manage margin flows. If price moves accelerate during periods of thin liquidity, such as holidays or overnight sessions, reaction time shrinks. Liquidity disappears when it is needed most. That is how markets gap rather than trade. This brings us to the most sensitive issue of all, delivery versus settlement. Futures markets operate on the assumption that only a minority of contracts will ever result in physical delivery. That assumption underpins the leverage of the system. When delivery demand remains low, the system functions smoothly. When delivery demand rises unexpectedly, stress propagates rapidly. Exchanges retain the authority to impose cash settlement under exceptional circumstances. This means contracts are closed at a reference price, and participants receive cash instead of metal. From a financial perspective, this resolves contractual obligations. From an industrial perspective, it solves nothing. Cash cannot replace silver in a manufacturing process. If industrial users rely on futures contracts to secure supply and are forced into cash settlement, they must immediately source metal elsewhere. In a tight market, that metal will not be available at futures prices. It will be available only at whatever price clears the physical market. This is how paper markets lose relevance during supply crises. The implications extend beyond silver itself. Counterparty risk becomes a concern. When one segment of the derivatives market comes under stress, participants reassess exposure across all linked markets. Margin calls in one asset class force liquidation in others. This is how localized commodity stress can ripple into broader financial markets. It is important to emphasize that this scenario does not require systemic collapse. It requires only a mismatch between paper promises and physical availability. That mismatch is already visible. The question is how far it must go before behavior changes decisively. Markets are not driven by certainty. They are driven by risk perception. Once participants perceive that access to metal is uncertain, hedging strategies evolve into stockpiling strategies. Futures contracts shift from price tools to insurance instruments. When that transition occurs, volatility becomes structural rather than episodic. In the next part, we will examine how government policy, export controls, and strategic resource management amplify these dynamics, and why time, not price, becomes the dominant variable. Because in commodity markets, when supply is constrained, power belongs to whoever controls the flow. When markets focus exclusively on price, they often miss the more important variable, control. In commodity markets, control over supply flows ultimately determines power. This is where policy enters the picture, and this is where the silver market transitions from a pricing story into a strategic one. As of January 1st, new export controls implemented by China fundamentally alter the global silver landscape. These controls are not framed as an outright ban. Officially, they are administrative measures, licensing requirements, and regulatory oversight designed to manage strategic resources. In practice, they function as a bottleneck. Any additional friction in export approval reduces the volume and speed at which silver leaves the country. For global markets already operating on thin margins of availability, that reduction matters far more than the wording of the policy. Over the past several years, China has been a net exporter of silver to Western markets. In 2024, exports totaled roughly 60 million ounces. In 2025, that number fell closer to 40 million ounces. Under the new framework, exports are expected to decline further in 2026. This removes a critical balancing mechanism from the global system. When Western markets faced deficits, Asian exports helped smooth supply. That safety valve is now partially closed. China's motivation is not speculative. It is industrial. The country dominates global solar panel manufacturing and maintains a massive electronics production base. Both sectors are silver intensive. Securing long-term domestic supply is a strategic necessity, not a trade tactic. From a policy perspective, retaining silver internally supports industrial continuity, energy transition goals, and technological self-sufficiency. This creates a structural shift. Silver that would previously flow westward now remains within Asia. Western markets must compete for a smaller pool of available metal. Competition under constrained supply conditions does not lead to efficiency. It leads to repricing. This is where the concept of strategic metals becomes unavoidable. Silver is no longer treated solely as a commodity. It is increasingly treated as an input critical to national and industrial resilience. Once a metal enters that category, market dynamics change permanently. Governments prioritize access. Corporations prioritize inventory. Financial efficiency becomes secondary. The effects of this shift propagate slowly at first. Contracts continue to trade. Prices fluctuate. Headlines focus on volatility. But beneath the surface, procurement behavior changes. Industrial buyers extend contract durations. They seek direct relationships with producers. They increase on-site inventories. These actions reduce the amount of metal circulating freely in spot markets. At the same time, investor behavior adapts. When geopolitical and policy risks rise, investors reassess the role of tangible assets. Exchange-traded products that once served as trading vehicles begin to function as strategic reserves. Holders become less willing to sell into short-term price strength, anticipating further supply tightening. This combination of reduced exports, increased industrial stockpiling, and declining investor liquidity creates a nonlinear environment. Supply does not decline smoothly. It disappears in segments. One buyer fails to secure delivery, another pays a premium. Soon, price quotes lose meaning because availability varies by counterpart. This is how regional pricing fractures emerge. The Shanghai premium is not an anomaly, it is a preview. As export controls take effect and inventories tighten, regional price disparities become persistent rather than temporary. The idea of a single global silver price becomes theoretical. Policy-driven supply constraints also complicate futures market hedging. Futures contracts assume fungibility. They assume that metal sourced in one region can satisfy demand elsewhere. When export controls restrict movement, that assumption weakens. Hedging becomes imperfect. Basis risk increases. Futures prices lose relevance to physical procurement decisions. This matters because futures markets are built on confidence in convergence. Prices are expected to converge at delivery. When convergence becomes uncertain, futures markets shift from pricing tools to volatility amplifiers. Participants trade defensively. Liquidity thins. Spreads widen. The broader implication is that time becomes the dominant variable. Markets can absorb high prices. They cannot absorb uncertainty over access. When access is uncertain, behavior changes faster than supply can respond. Mining projects take years to develop. Policy decisions take effect immediately. This asymmetry favors holders of existing supply. It disadvantages consumers dependent on continuous flow. It also redefines the role of capital. Capital cannot create metal on demand. It can only bid for what already exists. As export controls reshape trade flows, the silver market moves closer to a strategic resource model. In that model, volatility is not a phase, it is a feature. Price spikes are not anomalies, they are signals of control shifts. Mining leverage, valuation asymmetry, and capital consequences. When markets transition from abundance to constraint, valuation logic changes. In commodities, price moves do not affect all participants equally. They concentrate impact where cost structures are fixed and output is constrained. This is where silver mining companies enter the equation, not as speculative vehicles, but as leverage mechanisms embedded within the physical supply chain. Silver mining economics are unusually asymmetric. For many producers, all-in sustaining costs sit in the mid-teens per ounce. These costs include mining, processing, administration, and maintenance capital. Once those costs are covered, every additional dollar in silver price flows disproportionately to the bottom line. This creates operational leverage that is rarely appreciated during stable pricing regimes. Consider the arithmetic. A producer selling silver at $35 with a $14 cost captures roughly $21 per ounce in margin. If the silver price rises to $75, that margin does not double, it triples. The revenue line increases linearly, but the cost base remains largely fixed in the short to medium term. Profitability accelerates. This leverage is magnified by time. Mining companies cannot expand production quickly. New projects require permitting, financing, and development cycles measured in years. Even existing operations face geological and regulatory constraints. As a result, rising prices do not produce immediate increases in supply. They produce margin expansion instead. Markets tend to undervalue this dynamic until it becomes impossible to ignore. During early phases of commodity upcycles, equity valuations often lag spot prices. Investors focus on headline volatility rather than cash flow durability. This creates valuation asymmetry. Earnings rise faster than multiples adjust. In silver, this effect is amplified by the industry's historical underinvestment. Years of suppressed prices discouraged exploration and development. Capital flowed elsewhere. When demand accelerated, the pipeline was empty. That absence of optional supply is now structural. This matters because capital allocation follows certainty, not narratives. When cash flows become visible and durable, capital re-enters the sector. Valuation. Multiples expand not because of speculation, but because risk perception declines. Profit becomes predictable. Balance sheets strengthen. Debt falls. Optionality increases. There's also a distinction between silver price risk and silver access risk. Industrial consumers face access risk. Miners face price risk. When access risk dominates, price risk becomes secondary. This environment favors producers disproportionately because they control flow rather than depend on it. Another overlooked factor is jurisdictional stability. As silver becomes strategically relevant, geopolitical risk enters valuation models. Assets located in politically stable jurisdictions gain premium status. Supply security commands higher multiples. This further concentrates capital into a limited subset of producers. The feedback loop is clear. Higher prices improve margins. Improved margins attract capital. Capital strengthens balance sheets. Stronger balance sheets allow selective expansion. Expansion remains constrained by time. Time sustains scarcity. Scarcity sustains price. This loop does not require exponential demand growth. It requires only persistent imbalance. Even moderate deficits accumulate over time. Each year of deficit erodes buffer stocks. Each erosion increases sensitivity to disruption. Volatility becomes directional. For capital markets, the implication is not simply higher prices. It is repricing of risk. Silver transitions from a cyclical commodity into a strategic input. Mining equities transition from optional trades into long-duration assets. Time horizon becomes the differentiator. It is important to distinguish between short-term volatility and long-term structure. Prices can retrace. Markets can correct. Margin hikes can force liquidation. None of these events change the underlying constraint. They redistribute exposure. They do not create supply. This is where patience becomes a competitive advantage. Markets reward those who align with structural forces rather than short-term signals. In silver, structure favors holders of physical supply and producers with disciplined cost control. The final consequence is psychological. Markets anchored to historical price ranges struggle to adjust. Anchoring delays, repricing. Delays create opportunity. Eventually, anchoring breaks. When it does, repricing is abrupt. Silver is not unique in this respect, but its dual role as monetary metal and industrial input accelerates the transition. Monetary narratives attract attention. Industrial necessity enforces reality. When those forces converge, price becomes a function of access, not sentiment. Power in markets comes from control of flow. Money responds to constraint. Time determines outcomes. In silver, all three are now aligned. This concludes the analysis.